broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. This is, of course, Bazaar Morning Call. I'm Prashant. With me, my colleague Sonia, and Rima is with us here over the next 2.5 hours as well. Guys, hi, good morning. And as they say on a Friday, thank God it's Friday.
Yeah, I'm sure the bulls are saying thank God it's Friday for sure, because, you know, it's been 3 days now running that the market has ended in the red. And the global markets are not looking that great. There are some signs that there perhaps is a correction coming with the way the bond yields are going, the dollar index as well. So let's see. But we can't say thank God it's Friday because we're working tomorrow as well.
We're working tomorrow and we've got a long evening ahead of us with Reliance earnings.
But yeah, you should have just let it be. I mean, I was go into the weekend thinking, well, then in the morning you wake up and you say, oh, okay, you got to go to office for an hour, 2 hours, right? But in any case, there's a trading session tomorrow. It's going to be staggered, I mean, in the morning and then, of course, in the afternoon. We'll get you timings, etc. In a bit from now. But let's just kick it off with what you need to know as we begin another trading session. This is the backdrop into which we're coming this Friday into. So the last 5 sessions for the Nifty have been absolutely astounding in terms of moves, right? So first, you basically had a 500-point rally. And this was largely over 2 days, but I mean, end to end, it's 3 days. A 500-point rally, and then in the last 2 sessions from the highs that we made, a new all-time high, the Nifty's pulled back about 600 points or so. So, you know, net, if you just look at the change where we were 5 days back, absolutely nothing with all that has happened. The question is, right now is the pullback, the fall, complete for now? Just for now. I mean, that's the important critical part. We'll come back to this question in a bit, but as we do, let's just quickly address the overnight session as well. So it's positive. The Nasdaq was up about 1.3%. The S&P was up about 0.9% as well. US data was strong, so you had basically initial jobless claims, which were much lower. That's one. And you also had housing data, which was strong. So data out of the US continues to, I mean, you throw in the fact that on Wednesday we got the retail sales, which showed that the US consumer is in good health. And this paints a pretty good picture of what the US economy is looking like. Now, you had a Fed speaker, and there are many, but this was stood out. So Fed's Mastek, he reiterated his preference for rate cuts only in the third quarter, not March, not the second quarter, but in the third quarter, right? He said this, but market pricing for when the Fed will cut rates still stays at about 15 basis points for March. I mean, it's come off. Before last Friday, before Christopher Waller made those comments, that number was 25. It's come down to 15 for the month of March, but it's still there. Market's not completely pricing that rate cut starting March out. The 10-year was up about 3 basis points. We are at about 4.14. Nothing very dramatic, but it's, of course, moved up from the lows recently. Oil prices, they're up about 1.5%. We are back at about $79 in the Brent to a barrel. And of course, I mean, the big one, we're tracking US markets and we track NASDAQ, Dow, but we got to track the ADR, HDFC Bank ADR, right? So you had a 20% fall the previous 2 days, and last night the ADR was up about 1.6% or so. So that is good to see. Now, I just come back to that question. Is the pullback complete for now? Is the fall complete for now? How will we know? You basically have got to track the price action to answer that question. Now, the Nifty, first of all, the Nifty should not break the low that we saw, which is 21,285. That's the first condition. Then you basically watch bounces. Watch for a bounce to 21,704. I mean, the way to do it, when you get these kind of falls and if you get a bit of a interim kind of a pullback, is to track retracement of that fall from the all-time high 2 days back to the fall that we saw, to the low that we saw yesterday. The 50% retracement is 21,704. That's the first level which the market needs to climb, get its head above. And then you look at the 61.8% retracement of this 2-day fall, which is 21,000, roughly 804 if you want to be precise. Now, it could be, and I would imagine at this stage, sitting where we are right now, that the answer to that question is the pullback, the fall complete. I would answer in the affirmative, that yes, maybe for now it is done and we get a pullback. Whether this is a pullback which will, the retracement of the counter trend rally, or this is something bigger, we'll only know once we get to this 50% and 61.8% retracement levels, which is 21,700 and then 21,800 levels. Whether this counter trend rally fizzles out or not, we'll know once we get to those levels, really. Now, let's just get to the Nifty Bank as well and address the levels there. So for the Nifty Bank, it, by the way, retraced, it came off and dropped all the way to 50% of the full last October rally to the December high that we saw. That is 45,371. The low yesterday was 45,430. So we almost got to that level. And that's why the Bank Nifty, of course, led by HDFC Bank, has been the much weaker index. Here, watch for a bounce on the Nifty Bank. Again, it's a two-day fall retracement. The first number is the 38.2% retracement. That stands at 46,530. And the next level would be the same retracement of the two-day fall, 50% retracement, which is 46,868. Again, the condition is that the Nifty Bank should not break the low that we saw recently, which is 45,430. That's a low that we saw, intraday low that we saw yesterday. So I would imagine that for the time being, for the very near term, maybe this drop that we've been seeing perhaps is kind of done, and we start to move in the opposite direction. What to do in terms of whether this is just a counter-trend rally, we'll know at those retracement levels that we put out. The GIFT Nifty is indicating about a 40-point higher start. Sonia.
It's really all over the place, right? That's the only way to put it. I mean, very, very volatile markets is what we have on our hands. But this morning, the Nifty implied opening is about 20 points higher. Remember, the US markets also pulled back. There was a tech-led rally in the US market. So whether it was NVIDIA, AMD shares, all hitting record highs on the back of a chip surge as well. So a lot of those stocks did well. So there's definitely some bounce back on the cards this morning. Whether it is sustainable, time will tell, because we have a lot of cues to look forward to. Reliance earnings are in the evening later today, and the oil and gas sector in general has been on the weaker side this quarter. So we're expecting the oil to chemicals business to report weak numbers this time. So you won't really get a big trigger from Reliance Industries. ICICI Bank, Kotak Mahindra Bank will be reporting its earnings tomorrow, so keep an eye out on that. Now, in banking, it's very interesting what IndiSInd Bank did, right? IndiSInd Bank's numbers actually will soothe the market's nerves. The NIMs were good. They were better than what the street was estimating. And the market's big fear after what we saw with HDFC Bank was that all banks would report weak net interest margins. But that's not the case with IndiSInd Bank, which is a good thing. So the focus is now on companies that are delivering good results. IndiSInd Bank will be case in point. Market is rewarding good numbers. So we saw it with the case with Oracle yesterday, right? Oracle was up about 30-odd%. The Bank Nifty is the one I'm watching very closely. It closed at that 100 DEMA yesterday. So if it bounces back today, courtesy IndiSInd Bank, and of course expectations from ICICI as well as, Kotak, SBI, all set to come out, that will be the space to watch in the pullback. For the overall index, the broad range of the Nifty is somewhere at 21,300 to 21,600. Yesterday's high was 21,539. So that could be the resistance on the market on the upside. Also, as I was saying, the global markets are not looking that great. One, the bond yield, it's surging once again above that 4% mark. Two, the dollar index is also showing a bounce. It's now above 103, 103.4. So global markets are definitely showing a sign of correction, and that's not a good thing for our own markets. So pretty much all over the place. But yes, this morning some pullback is on the cards.
And there were also some demand concerns, right? Macy's, the prominent retail store, they've announced job cuts to the tune of about 2,350 employees. And they've also said that they're planning to shut down 5 stores. Maybe it's a move towards online, spending. But the fact is that physical stores of Macy's, a large brand there, retailer, is planning to shut down. But a quick word on Asia before we, get started. Asia's off to the races, actually. You've got Japan, which is up 1.5%. Japan released its inflation data. And inflation in the month of December has cooled for the second consecutive month and now at the lowest level since June of 2022. The Japanese central bank will be meeting on the 22nd of January. So this is the last data point going into that. And the Nikkei market is up 1.5%. Taiwan is the other one showing you considerable strength. And that's borrowing the chip maker rally that we had with TSMC raising the forecast to 20% for FY20, calendar year 2024. So all the semiconductor related stocks are doing very well in Taiwan, and that's fueling the rally there. Hang Seng is up close to about 0.5%, but Korean markets too are up nearly 1%. So, Asia's actually on a pretty good note. You spoke about the big earnings, actually Reliance and HUL. These are the two big ones, and these have been the two underperformers. So Reliance Industries in the last 1 year has only given you a rally of 10%. Of that, 5% has come in only since the beginning of the year. So it's not been a stock which has participated. And the other one is HUL. Now, at a time in the last 1 year when the Nifty FMCG index has rallied 26%, HUL is down 4%. So HUL too has been quite the underperformer. And since you guys spoke about, Saturday's, trading, let me just put on board the timings for tomorrow. So the first trading session will be between 9 and 10 a.m. and the second trading session will be from 11:15 to 12:30. So 2 trading sessions staggered with a 1-hour break in the middle.
Okay, long day ahead and long weekend ahead for us here, especially guys who are trading. But let's see how things shape up. For now, looks like it's going to be a decent opening in trade, and then we'll take it from there. On the equities, first up, we have Seshadri Sen of MK, who says their 2024 year-end Nifty target of 24,000 imputes an 11% return for the benchmark, while they expect small and mid-caps to outperform. He says their model portfolio focuses on large and mid-caps, and they are underweight on financials and overweight on consumer discretionary. He also says key themes for 2024 are rate cuts, the budget and reform, and probable revival in mass segment spending. He says earnings growth should continue in the mid-teens with rising return on equity. He says small and mid-cap earnings growth should exceed the Nifty and drive further outperformance.
Okay, well, let's get you some money market views as well. This is V. Lakshmanan, a Federal Bank, who says that the bank of robust data, the US 10-year yield traded above 4% levels, while the dollar index traded at a 1-month high. He says the strength of the USD was complemented by the FII outflows in Indian equities, which weighed on the currency. He expects the pair, the dollar INR, to trade between 82.92 to 83.38 to the dollar in the next few trading sessions.
All right, and on the bonds, Lakshmanan V speaks about how domestic bonds saw buying interest as December's CPI was lower than expectations with a fall in core inflation. He says US Treasuries rose and remained above 4% after stronger than expected US retail sales and rise in UK inflation in December. He says the markets seem to have trimmed the odds of an early rate cut by the US Fed. Also, the coming sessions could see the 10-year benchmark bond yield trade in a range of 7.15 to 7.25%.
We have lots of stock-specific action to track today. We'll get to it in just a bit in our special Top 10 segment. We're looking at IndiMart Bank, Finolex Industries, Shalby, Lupin. These are on the radar on the back of positive news flow. Metro Brands, Home First Finance, Supreme Petrochem, 361, Dixon Technology, Shoppers Stop are the stocks on our radar that are likely to open in the red. Get into a break. Our list of top 10 stocks is lined up next.
Bro.
Welcome back. Today is a big day of earnings. We have Reliance, HUL, Ultratech Cement coming out with numbers, and tomorrow a slew of banks as well. But let's talk about the top 10 stocks to watch. IndiMart Bank reported a bit of a relief on their net interest margin. So I think the street will take that positively. But Abhishek is here to give us a better understanding of the numbers. Abhishek, morning.
Morning, Sonia. So as you mentioned, it's one of the rare instances where the net interest margin has remained steady for 3 quarters in a row at about 4.29%. And it's a relief given the fact that other lenders are seeing a decline in the net interest margin on a sequential basis. So what has worked in the result? The net interest margin continues to remain stable. 12 quarters of operating profit growth of both YOY as well as sequential growth that you are seeing for IndiMart Bank. This time it's up about 8.6% YOY and more than 3% sequentially. So in terms of return ratios, ROA is the best in last 17 quarters coming in at 1.93% and ROE is the best in last 16 quarters coming in at 15.45%. On the flip side, Tamil Nadu floods did have an impact on the slippages. So slippages increased to 1,765 crore, which is up more than 20.5% on a sequential basis. Annualized slippage ratio is at 3-quarter high of about 2.16% when compared to 1.9% in the previous quarter. Their operating efficiency is bad. Cost to income ratio is one of the highest that you are seeing in last 7 years. However, in terms of P&L, both the ANA and PAT is a beat on our poll. Back to you.
Thank you very much for that. Over to Mangalam now for Metro Brands. Mangalam.
Well, discretionary consumption hasn't picked up too well, and as a result of which, add to that the weakness that we've seen in the business on account of the Fila Brands acquisition. All of that has meant that revenues for Metro have grown just about 6% There was a high base as well. The EBITDA has actually declined by 3%. That means the margins have come off by about 300 basis points. And as a result of which, the net profit has declined by about 12.5% as well. For Cravatex, which is the Fila business, the revenues for the quarter have been 8 crore and the EBITDA loss has been about 12 crore. The management had alluded that, there could be EBITDA problems for the next couple of quarters, and the companies continued to expand their store base as well. So see some red for the opening, but management commentary and on growth and growth of Fila, etc., will be extremely important.
Right, Mangalam, thanks very much for that. That's Metro Brands, and you'll hear from the management a little later here on the program. Finolex Industries is the next one we are focusing on. Upasana is here with details. Upasana.
Q3
I think we have some issues there with Upasana, and we'll come back to Finolex Industries in a bit from now. But let's go on to Pharma. Ekta is here. Ekta, good morning. Shalby and Lupin in focus?
Well, yes, very interesting acquisition by Shalby. It's a small one, but it's interesting because it will really ramp up their focus in terms of international patients. So they're going to be acquiring 87% stake in PK Healthcare, which is Sanar International Hospital in Gurugram, for around 102 crores. The stake will be bought within a period of 1 month. Now, the investment, according to the company, is in line with their strategy to accelerate their presence in the Delhi NCR region, with a vision to scale up the international business and consolidate their presence in the north. Now, it is supposed to be located in one of the prime locations of Gurugram. It's a 1.2 acre land. It has a current capacity of around 130 beds, and they can expand it to 180. Hospital generates 70% of business from the international space, and it caters to more than 60 countries, and that's the key point which Shalby is probably going to benefit from, because there's so much focus on in terms of international travel, medical value travel, and hence this would be probably a very good addition to them in terms of scaling it up. Separately, Lupin, they've got a US FDA nod for Uloric generic. It will be manufactured at their Pithampur plant. It is used for patients with gout. Sales are small, around $27 million, so it's a normal approval for Lupin, but they have received a spate of approvals and launches in the US markets, so it'll probably add on in terms of sentiment.
Thank you very much for that. Abhishek is now joining in on Home First Finance. Abhishek.
Well, it looks like a strong set of numbers on the, AUM growth front. However, take it with a pinch of salt, with a bit of negative coming in, and asset quality, gross NPA and net NPA, value-wise rising by about 5% and 5.7% quarter-on-quarter respectively. AUM growth is pretty strong at 33.5% YOY and about 7.7% sequentially. You are seeing increase in tenure, which has actually aided in AUM growth this time around. The NII growth is about 35.3% YOY and about 6% sequentially. PAT growth is about 34% YOY and about 6% sequentially. However, the net interest margin declined to 5.7% when compared to 6.4% in the same quarter last year and about 6% in the previous quarter. Spreads have also come down by 20 basis point quarter on quarter and about 40 basis point on a YOY basis. The other factor to look into the number is the sharp capital consumption. So, capital adequacy ratio is at 40.9% when compared to 45.5% in the previous quarter. This capital consumption of 460 basis point for a 7.7% sequential growth looks to be on the higher side. Back to you.
All right, thanks a lot for that. Well, Finolex Industries is the other one that we're looking at this morning. Upasana is here to tell us more about that. Upasana, over to you.
Well, Finolex Industries reported its Q3 FY24 numbers, and we are seeing a revenue degrowth of almost 9% on YOY basis, while the PAT is up by almost 20%, mainly due to higher other income and lower expenses. The reported EBITDA by the company is also up by 31% at 120 crores, and EBITDA margins have expanded by 360 basis points at 11.8%. Coming to the sales volume of the company, they are down by about 19%, leading to a revenue degrowth. While talking about the revenue mix, the PVC resin stands at 25% of the revenue mix. Now, coming to the revenue logged by the segment, the PVC resin, the revenue is down by almost 36%. EBITDA margin stands at 9.7% versus 2.5%, and sales volume are down by almost 32% on YOY basis. Now, coming to pipes and fittings segments, which is almost 75% of the company's revenue mix, The revenue in this segment is down about 8% on YoY basis. The EBITDA margins stand at 7.5% versus 6.4%, and sales volumes are down about 10% on YoY basis.
All right, Upasana, thanks very much for that. Well, Supreme Petrochem is the next one we are focused on. Back to Sonal. Sonal, morning.
Good morning, Prashant. Well, for Supreme Petrochem, on a quarter-on-quarter basis, it was a decline because remember, we've seen cracks going down in the quarter gone by. The entire petrochemical segment is seeing some pressure. So their revenues declined 7%. We had EBITDA decline of 11%. Margins slightly lower at 8%, leading to a profit degrowth of 13% as well. The company said that their volumes came in at 1.7% in terms of an increase on a YY basis. That means that realizations could be under some pressure, and that has been the industry-wide phenomenon as well. Interestingly, they say that Red Sea issues are impacting the exports to the USA, Europe, including Turkey, and this started by the end of November. So this is something that we'll be tracking closely because export is also an important part of their business.
Thank you very much for that. Back to Upasana for some more stocks which are in the news.
Well, first up is Dixon Technologies. The Directorate of Revenue Intelligence conducted a search with respect to the classification of the raw materials imported for the manufacturing of one of the products at the manufacturing facility in Noida on 17th of January 2024. Company says the impact of financial operation or other activities of the listed entity cannot be quantified at this point of time, and according to the company, it will not have any material impact on the financial or any other activities. Next up is Shoppers Stop. The net profit is down by almost 41% on YoY basis, while the revenue is up about 9% on YoY basis. The EBITDA margin stands at 18.1% versus 21.2%. Well, that's the reason we are seeing weak numbers coming in from Shoppers Stop. Coming to 361, on quarter-on-quarter basis, their revenue is up about 3%. Brokerage income is down almost 13% on YoY basis, while the other income is up about 97% on YoY basis, while the operating profit before tax of the company is down almost 2.5% on YoY basis. Now coming to the PAT of the company is up about 5% on YoY basis.
Right, thanks a lot for that. Here's a quick recap of our top stocks. Stocks with positive news flow: IndiMart Bank, Finolex Industries, Shalby and Lupin. While stocks with negative news flow: Metro Brands, Home First Finance, Supreme Petrochemicals, 361, Dixon Tech and Shoppers Stop. But let's also get a quick grip on what's happening in the world of commodities. Manisha Gupta is joining in for a roundup of all the action there. Manisha, hi, good morning.
Morning, and thank you for that, Sonia. Well, I'm looking at the crude oil prices today because we are looking at support coming in from the strong demand estimates that have been projected out by IEA and also OPEC. So IEA believes that for 2024, we could be looking at a demand growth of 1.24 million barrels per day, while OPEC has put out a number at 2.25 million barrels per day. So there is strong demand estimates for this year. Add to that the geopolitical tensions that we are seeing in from the Middle East. There also are reports of extreme cold in North Dakota that have led to some disruptions in crude production there. And then the U.S. crude inventories also have seen a decline by 2.5 million barrels. So everything really seems to be working in favor of crude prices trading on a firmer note. But that's just that while we have seen gains in energy, the metal prices have seen a decline. So gold is down 2% in this week, and that is because the dollar index is trading at a one-month highs. The metals also have seen pressure in this week. You have copper trading at one-month lows. The weak fourth quarter GDP numbers from China and very mixed data for the rest of the numbers as well seems to be weighing on metals. Until now, in this year, in the month of January, have all performed on a negative note.
Okay, Manisha, thank you very much for that. So that's basically commodities in focus. Now, the Reserve Bank of India Governor, Dr. Shaktikanta Das, rules out any rate cut in the near term. Speaking with my colleague Shireen Bhan at the World Economic Forum in Davos, he said growth momentum is secure and 7% estimate for this financial year was a conservative one. Listen in.
Whether it is the industry or the private sector, or it is the, the analysts or the economists or the serious, the market players. In the context of India, I don't think anybody is expecting a rate cut now. In most of the advanced economies, the markets and the stakeholders and the market players, their assumptions, it is ahead, they're overrunning their central banks. So far as India is concerned, I think the thinking of the central bank and the thinking of the market participants, they're much better aligned. In inflation, with regard to inflation, I have said elsewhere that our policy has to remain actively disinflationary till we reach the target of 4% on a durable or a sustainable basis. You are right, absolutely right in saying that any premature pivot in our policy, it can be very, very costly for the economy. If you see the last 1 or 2 years, the deposit growth has been around 12 to 13%.
Yes.
The credit growth has been about 15%. Now, obviously, you see, it's not that you get X amount of deposit and you extend that X amount as a loan. It's not like that. Share prices in the stock market do not necessarily reflect the fundamentals of a company. I'm talking in general terms, not with reference to a particular bank. Generally, if you see, the stock prices are determined by so many other factors and do not necessarily reflect the fundamentals of a company. You have examples in every sector, whether it is the financial services or banking or any other sector you look at. There are companies with very strong fundamentals, but its share prices should be low. And the converse also happens. So therefore, it will not be correct to, judge the health of a particular sector like banking in particular in terms of share prices, movement of share prices, and that too on a single day.
There is a concern or perhaps confusion as far as the credit deposit ratio is concerned and whether the RBI is likely to mandate a number or not. Could you clarify this for us?
You see, we have not mandated any number. I think there was, let's leave that. But what I would like to say very clearly is that we have not mandated any number that this shall be the credit deposit ratio. We have not. And at the moment, we don't propose to. Because credit deposit ratio is just one of the parameters to assess the health of a bank. There are several other parameters. So you have to look at it all in totality. All that I can say is that there should not be exuberance in lending, number one. Number two, there should be some correlation between your deposit base and your credit growth. There should be some correlation. But in terms of hard coding it, in terms of a particular number, there is no such proposal in our mind, and we have not prescribed any such number.
On the back of the measures that you've already taken, and one involving the AIF, so there are representations being made by that industry, by the AIFs, etc., to the Finance Ministry as well as to the Reserve Bank, saying that perhaps there needs to be a review of that decision or at least more time given. You've obviously, I would imagine, have heard from them. How do you respond to that?
You see, this decision is the result, is the culmination of more than 1 year of keeping track of the developments in the AIF sector. It's not as if suddenly something came to our notice and we acted. We have been tracking these developments for about more than a year now. And initially we saw some signs here and there. So when we see some signs here and there, we try to deal with it on entity-based approach. Our supervisors take it up with that particular entity and try to deal with it on a bilateral basis. But when we see something, becoming, showing signs of getting widespread, we had to act.
How widespread is the problem today?
No, I can't again quantify it, but there was this whole issue of evergreening that was taking place. So therefore, that had to be prevented. All that we have done is that we have also said we have not stopped any lending. We have only said that if you want to continue, you treat it as, you treat it in a particular way and you provide for it in your accounts. And so that is what we have said. And some representations have come, they are being examined.
But could there be any kind of review as far as the decision is concerned?
No, I can't say. It is being examined. We have got number of representations. They are being examined. And with regard to the decision, it's a well thought out decision to prevent a kind of a new source of stress or a new source of problem for the Indian banking sector.
The other stock, which is on our radar, is Tata Communications. Came out with numbers yesterday, good set of numbers. The stock closed up with a gain of about 4.25%. If you look at the numbers on a quarter-on-quarter basis, revenues have jumped 15%. The bottom line shows you a very sharp decline, and that's on account of an exceptional. But you know what the street liked yesterday is one of the acquisitions the company had done, Kalera, got integrated only in Q3 in October. And the company had earlier said that this acquisition will only turn EBITDA positive after 1 year. But the company managed to turn this acquisition positive at the EBITDA level in the first quarter itself. And that's what the street latched onto. So we chatted with the management, Mr. MD and the MD and CEO, Amur S. Lakshmi Narayanan, on the Kalera acquisition, how the demand outlook is shaping out. Listen in.
Kalera margins we've called out, it's 5%. EBITDA. But I wouldn't read too much into just one quarter. I think there are we need to get all of the business to see if there are any cyclicality, if there are any other costs coming in the subsequent quarters. So we are as I said, we're very pleased with the efforts of integration and fast tracking some of the activities. But we will carefully and closely watch the integration performance going forward. We will still maintain that our medium-term goal in Kalera would be to get it to a double-digit EBITDA. I think on the underlying basis, our revenue growth was year-on-year 6.6%, but our YTD growth on the underlying basis, which is organic one, is 15.1%. So. I think I would look at more the YTD rather than a Q-on-Q or a Y-on-Y. We definitely saw relative to the last few quarters or even last year, there is a slowdown, but 15% YTD is still very creditable given the macro conditions that we are operating. Overall, order booking this quarter has been similar to the last quarter. I think we had our peak of order booking in the H1 of last year, and thereafter it had slowed down a bit. And it's maintaining at that similar levels, I would say, in this year as well.
All right, well, that's Tata Communications. Lots of interest in that name. We'll take a quick commercial break here. We'll come back. We'll have the management of Mastek who will be with us for the third quarter earnings. So that's coming up. Siddharth Khemka of Motilal Oswal Financial Services will join in on market stocks a little after that conversation with Mastek. That's coming up. Stay with us.
EPAC Durable Limited now.
Welcome back. Mastek is on our radar. The company reported a steady quarter in Q3 with a top-line growth of 1.5%. The company's margins came in at 17%, which compares with 16.1% on a quarter-on-quarter basis. Now, we're now joined by the management of the company, Mr. Hiral Chandana, on the show now. Thank you very much for joining in. First, if you could tell us the contribution of the acquisition BizAnalytica in the current quarter. What was the organic revenue growth? And even for 9 months, you've reported a constant currency revenue growth of 15.5%. What would be the organic revenue growth, and what's the outlook looking for the for Q4?
Absolutely. Thanks for having me. So let me quickly recap our quarterly results. Our year-on-year revenue growth was roughly about 19% in rupee terms. Our EBITDA, our operating EBITDA, which we report, like you said, 17%, also grew 17.4% year-on-year. And what we're really pleased about is our order book. And we report our 12 months order book backlog. And that also grew about 21%. So all in all, we feel good about the deal momentum, the demand environment, and as we look at the future. BizAnalytica was the acquisition that you referred to. We completed, or we made that acquisition in August. We've actually fast-tracked that integration, and it's now completely part of our Mastek family as the data, cloud, and modernization business. And actually that contributed to the full quarter revenues as well. Previous quarter, we had 2 months of BizAnalytica This quarter, we had 3 months of Business Analytica. But for the 9 months period as a whole, the only acquisition inorganic was the Business Analytica revenue. And so that's the 2.5 million from the previous quarter and then the 4 odd million from this quarter. So that's as far as Q3 is concerned. As we look ahead, there's a few kind of interesting dynamics happening in the industry. As you know, cost is still a concern for customers. But what we are seeing more and more is that many of our clients are breaking down their initiatives into more short-term initiatives, in some cases, smaller programs, right? They're waiting to see how Gen AI, some of the disruption will impact future applications. So that's one trend. In our particular business, we do a lot of business, as you know, with the UK public sector. They spend about 12 to 13 billion on central government, on the health, as well as on defense. That's our sweet spot. So the critical national infrastructure that we support continues to be resilient. But what we are most excited about is the whole data play. As companies have figured out, looking at Gen AI use cases, what they've realized that it's going to be a combination of data, ML, and AI. And to create large language models, the data plumbing and foundation is going to be critical. So the Business Analytica amplification for our data cloud business with Snowflake and Databricks forms a strong foundation for some of those programs where data is moving to the cloud. So all in all, we're fairly pleased with where we are. It was a furlough quarter, so obviously seasonally weak for the industry. But as we look at Q4, which is the coming quarter here, we're looking good in terms of continuing our growth momentum.
Okay, it's good to see that the deal momentum continues and, the demand trends are positive. But I wanted to understand about the margins a little bit, Mr. Chandrana. You had guided for margins between that 17 to 19% band. Are you on track to doing that? And is there visibility of continued margin expansion from here?
Yeah, so Sonia, we given that band of 17 to 19%, like you rightly said, and we feel comfortable in that band. Last quarter was a little bit of an aberration with the wage hikes. Some of the other companies did not do the wage hikes. We, wanted to stay with that commitment for our employees. But yeah, we have touched 17% this quarter. It's based on strong operational levers and leverage. So we continue to make operating model transformation changes to simplify, automate our internal systems and processes as well. As we look at the future, we're fairly confident of continuing to increase that margin profile. But we still like that band of 17 to 19% so that it allows us enough to invest in our new solutions as well as capabilities, but more importantly in our accounts. Many of our accounts have started to become 5 million, 10 million, 15 million accounts. There's one account in the US, healthcare account, which was 1 million or less than 1 million a year back, and now it's 15 million today. So we're very excited about the account mining. Some of the work that we've done in the last 18 months is paying off. So we want to participate in larger deals and larger accounts. And so that 17 to 19% band is still comfortable.
Mr. Chandrana, you spoke briefly about the UK business, right? The public work that the government work that you do, defense, healthcare, etc. Yes. Revenues were down about 1.5% quarter on quarter. Could you tell us why and what's the outlook there? And, coming off other IT companies from who we've heard recently, LTI, Mindtree, for example, told us that fourth quarter should be similar to the third quarter. You sound more optimistic, so if you could just address both those points.
Yeah, no, absolutely, Prashant. So we also have a currency play here, first of all, right? So the GBP to kind of US dollars is one factor there. The Q3 is a furlough quarter for both UK and US, as you know. But in terms of our digital business and the bulk of the work that we do for our public sector, that's actually continuing to grow well. In fact, we were recognized by the ministerial offices for helping with their, controlling the immigration, fast tracking the backlog that they had, and the work that we do for the asylum policies, as well as the Home Office has been recognized. We continue to see a good growth out there. I know some of the other companies have announced or mentioned about continuing furloughs. We don't see that risk. We believe that Q4 is going to be a normal, solid quarter for us as we increase the number of working days, etc. So in fact, typically Q4 happens to be a good quarter in general for us. So as we look forward in the UK public sector, what we are focused on is the policies. In fact, we talk about policy over technology, right? So many of the critical policies that we're involved in, which is biometrics, which is asylum, which is some of the departments of justice, even as we look at future, are critical policies that we're focused on.
All right, we'll let you go on that note. Have a great year. Thanks a lot for joining in, and we'll again touch base with you in the next quarter. Thanks for being with us on CNBC TV18. But let's do one thing. Let's move on. Siddharth Khemka, the head retail research at Motilal Oswal, joins in now to talk about some numbers. Siddharth, hi, good morning. I think the relief has come in on IndiSInd Bank with the margins being stable, as opposed to the concern that after HDFC Bank, all banks would see margin pressure. But what would you do with IndiSInd Bank as a stock now?
Yeah, very good morning, Sonia. So if you look at, I think IndiSInd, we are pleased with the numbers. They are in line with our expectations, at least. If you look at the net profit growing 17% to 23 billion, this was aided by a healthy revenue growth as well as lower provisions. Loan growth was healthy at 20%. Traction we saw in both corporate as well as consumer books. Deposits grew was at 13.4%. So overall, the only concern that we see is that there has been some slippages, fresh slippages on a Q&Q basis, mainly in the corporate book. And that too, so the overall corporate book slippages increased to 3.12 billion, and of that, 1.4 billion was put into one large account. And there is some concern on the elevated slippages from the vehicle finance book. But overall, we see that IndiSInd continues to report a good inline performance, healthy NII growth, controlled provisions. Asset quality remains quite stable for them. And we are expecting a good growth going forward, 21% earning growth over the next 2 years. ROE should improve. And the healthy provisioning in the MFI portfolio and moderation in the overall slippage run rate should lead to a reduction in credit costs. So that should lead to an ROE of 16%. And hence, we continue to remain very positive on IndiSInd. It is one of our preferred picks within the smaller private banks. We have a target price of 1900 and a buy rating on IndiSInd.
All right. So that stay with us. We'll come back to you for more. I want to get your views on Tata Communications as well, which has done well. Anuj is here, though, with how he's looking at the market. Full Friday mood, Anuj. Good morning. But I must say, Friday is Friday, but tomorrow is also Saturday and it's working.
Yeah, it is, but
so it's technically not a Friday today.
I am not actually. I have some commitments already, so I won't be there, and so that's
it's Friday for you.
So it is Friday for me. Obviously, we as a channel will be working, but I'm not there tomorrow, so I thought why not be in the Friday mood. And like they say, "Dubte ko tinke ka sahara." Today, the Bank Nifty will have IndiSInd Bank support. It's at least soothes some nerves after that. Big one-day fall that we saw, or rather 1.5-day fall that we saw in the Bank Nifty with decent net interest margin. I think that's something that the market will latch on to today, that it may not be across the board issue. It could be just perhaps an HDFC Bank issue. So one leg of correction in Bank Nifty could be coming to an end. It also closed at 100-day exponential moving average and 20-week exponential moving average. So I think there's some support here. But my sense is that over the next 3 or 4 weeks, it's possible that you test the 200-day moving average, which is around 44,500. That perhaps is possible. Now, in terms of what next for the market, one thing which you can do is focus on companies delivering good numbers. Even in this market, they are being rewarded. Oracle was a case in point yesterday when it surged 30% after that stunning numbers. In terms of Nifty, the low yesterday, 21,285, that's sacrosanct to keep an eye on. Markets normally test panic lows to check if there's some kind of double bottom or not there. So there could be some short covering rally, but over the course of next few days or weeks, it's possible that you test 21,285 once again, just to check if that level holds importance or not. And lastly, if you look at the FI long exposure, that's been coming down drastically. So the market, which was extremely overbought, has now gone into some kind of neutral territory. It's not extremely oversold yet, but it's gone into neutral territory. The long exposure is down from 70% now down to almost 49%.
Anuj, thanks a lot for that. Enjoy your weekend. Thanks for giving us an update on the market. So let's see, things are still a bit volatile, tricky. Global cues not looking that great. Let's take a quick break. Up next, Mitesh Thakkar and Shrikant Chauhan will join in for some technical trades. Stay tuned.
Okay, welcome back. I think we're just sort of counting down the minutes to the pre-open session. Mitesh is with us and so is Srikanth, as always, on Fridays. Gentlemen, great to have both of you here. Thank you very much for your time. I think the implied open is about 60 plus points now. The question, Mitesh, is have we, everything happens in double quick time nowadays, right? Rises and then falls also. So have we completed 2 days back we were asking, have we completed something on the upside? Now with 600 points gone in 2 days, at least in the near term, have we completed something and are we likely to get a decent kind of a bounce? I was looking at retracements of the 2-day fall and the 50% retracement is about 21,700. Is it possible we get bounces to that degree? Your sense?
Good morning, Prashant. So, we were talking about this pattern of violent reversal a couple of days back, and I highlighted 21,500 is the minimum. 21,300 is where a couple of modified moving averages come in, where I think the market could take support. We got a low around that level yesterday. I think 21,300 remains the key. As long as we are above that and we are not recording a close below that, I think good chance that we will see not only a bounce back, maybe a couple of bounce backs from these levels, and then that could emerge as a consolidation. But yes, I think this should at least, the first attempt should at least give you a decent throwback. Now, looking at those levels, the stocks, the index level which can be tested is first back to 21,520. In the good case scenario, 21,750 also can be tested.
All right, we have Srikanth Chauhan also joining in. Srikanth, how are you feeling about this market now? Do you think this pullback could be durable? Because it's been 3 days of non-stop selling. If we do get relief, what would you do in the market today?
Good morning, Sonia. Good morning, Prashant. Yeah, I think the way the market has fallen nearly 4% in just 3 days, and in that also we saw good amount of correction in almost all the private banks. So we are of the view that now we are very close to the crucial levels, and yes, we can expect some rebound, as Mitesh said. 21,250 is now going to act as major support. So we may see some sideways activity or some rebound in the market, but yes, we are not expecting market to cross the level of 21,750 so easily, which is 50% retracement of the entire fall. So we may see some range bound and some narrow range bound sort of activity in the near term. But for the Bank Nifty, there we saw a classic reversal pattern on the day of weekly expiry. It was very close to the 50% retracement of the entire rally that we saw from the lower levels. So here we are expecting furthermore upward activity in the near term, and 45,300 should be the final stop loss for holding any long positions. There also we are expecting 46,300 or 500 on the higher side, and stock specific activity is definitely going to rule the market.
All right, let's get trades out of the way as well, specific stocks. Mitesh, what do you have?
Prashant, I've been recommending, even in the fall, I've been recommending IT stocks. So I have a buy on TCS today. Recommend to buy here with a stop below levels of 1120 and a target of 1185, 1195 can be looked at to begin with. Maybe we'll look at higher levels eventually. So the possibility is there. So TCS is the first call. I have a buy on Cipla as well. Good rebound there yesterday from lower levels. Buy here with a stop at 1300 for targets of 1365. IndiSInd Bank, the numbers are good and the pattern isn't very weak. So I think this stock can give a stronger bounce back. That's a buy with a stop at levels of 1595. And I would look at a target of around 1660, 1665 to begin with. And I'll keep one sell call. Tata Steel, if it starts breaking below 129.5, go short with a stop at about levels of 132.5 and a target of 123 can be.
All right, and Srikanth, what about you?
Yeah, like when there was some weakness in the market, in the second half when there was recovery, we saw activity specifically in capital goods, infra and energy stocks. In that we like BHEL, which is around 212, and it has broken almost all its important multiple levels of past several years. So from here, the stock can move to the levels of 225 or 230. So it's a buy at current levels with a stop loss around 208. And we also like Bank of India, which was relatively outperforming to the other bank stocks. So Bank of India is also a buy at current levels with a target of at least 143, 144. We can keep stop loss around 129 for the same.
All right. Well, thanks a lot for that, gentlemen. Let's take a short break. On the other side, we'll have the pre-opening rates. We'll also have with us Anurag Mantri of Jindal Stainless for their Q3 earnings. Do stay tuned in for that. Welcome back. We're just counting down to the pre-opening rates. Looks like it's going to be a decent opening, but let's see. It can be very volatile as well. We have a lot of big numbers coming through. But Siddharth Khemka of Motilal Oswal is still with us. Siddharth, earlier we were talking about IndiSInd Bank's positive performance. What about HDFC Bank? There was large delivery-based selling post the numbers, a lot of disappointment there. But for long-term investors, is this a good time to be buying HDFC Bank, or are you cautious?
So, Sonia, if you look at HDFC, the street's reaction is, to some extent, you can say a bit exaggerated because the large holding that the FIs and DIs have. There is some concern with regards to the NIM compression. The cost to income ratio has gone up definitely. The bigger concern is on the deposits growth. I think that is where the street is most concerned, that if that doesn't pick up, the overall business growth could get hampered. And what we have seen, the provisions which have gone up, including the contingent provisions and last quarter and as well as this quarter, the near-term expectation is not very strong from HDFC. Having said that, you rightly said, if someone is looking at the longer-term picture, the correction does offer a good entry opportunity, but just keeping in mind that one needs to buy this not for the next 1 or 2 quarters, but for at least 2 to 3 years, and things should improve with the overall improvement that we are going to see in the overall credit growth in the banking business, and with the rate cuts that would be expected towards the later half of the year, that should help elevate some concerns on the NIMs, and that is where when I think the stock should start reacting positively.
Siddharth, do you look at Shalby? They've made an interesting acquisition of a hospital in Gurugram, a hospital which generates about 70% of its revenues from international, patients. So medical tourism, it's a big beneficiary of that, the acquired company. So do you look at Shalby, and any thoughts on this?
So, Rima, we don't look at Shalby. We have not covered that. We cover some of the larger ones like Indian Hotel, the Apollo hospitals, the Medanta and Max. Within that, overall, we are very positive on the healthcare space. We believe that there is a good growth. Shalby has a niche, as you rightly said, created with the international patients that is doing well. But within our preference, we have Medanta, that is your global healthcare, which is our preferred pick. We also have a positive view on Apollo hospitals as well as Max Healthcare.
By the way, the pre-open is on with us, and it's a strong start. I mean, it was just the first 2 minutes, so things will settle down. It won't be a 250-point higher start, but should be decent. In any case, Siddharth, the Tata Communications, Rima was, of course, speaking with the management earlier. There is an upgrade from IIFL as well, and IIFL is saying that it's a strong one, especially given the context where everybody else has been reporting weak numbers. Any thoughts, briefly?
Yeah, Prashant. So I think results have been much better than expectations. The good positive surprise was the EBITDA improvement in the subsidiary Kalera that they have acquired. We were expecting a marginal loss. They have reported a strong profitability on the EBITDA front. And with that, we have also upgraded the estimates. We have raised our estimates to factor in the higher EBITDA run rate. I think numbers are better. The only thing is the stock has also run up, and there is some growth visibility. The management has clearly said that they would be looking at growth. They have set a very ambitious target in terms of the next few years for the revenue. So they have a target of 280 billion rupees of revenue by 27, and which would be supported by both organic and inorganic initiatives. So some of these inorganic initiatives that is leading to a higher debt, plus a little bit less in terms of growth visibility. But nonetheless, very strong numbers. Stocks should react positively. We have a neutral rating right now, given that the valuations have a bit on the higher side, and we see limited room for upside given the only upside that we are looking is for improved growth visibility could be a vital for the re-rating of the stock from here as well.
Siddharth, thank you very much for joining in today. IFL has upgraded it from a reduced to an add, and the target price has been set at above 2,000 rupees, and currently it's at 1,800. So they see about a little more than a 10% upside in Tata Com. Jindal Stainless Q3 performance also came in better than street estimates. The top line, though, was lower as volumes declined 6% sequentially. Nigel caught up with Anurag Mantri, ED CFO of the company. Listen in.
Last time we were anticipating that our export were actually earlier not doing well too much because of the European market, our targeted premium market like Europe and US were not really seeing a much larger demand. But we were expecting that Q4 exports should open up. But however, what have unfolded in last few days in the last quarter of Red Sea and all the situation and even the European demand not reviving to that extent, we are not seeing a very high uptick in the export volume. So our earlier target for this year export was 15%. I think we will not be able to move beyond 10 to 12% because of all these ocean freights have increased and the export markets are not showing much of the potential right now. However, we will still be able to meet our volumes of 20% increase over FY23 because as you know, we have made our business model so agile, so we can actually switch between export and domestic market very well. So we will we maintain our guidance for 20% volume growth despite being export not contributing in this quarter also.
Okay.
And on EBITDA per ton, 19 to 21,000 were our guidance. Right now, however, seeing the market and since export we are facing a challenge, 21,000 is not likely a scenario, but we will still be able to meet our guidance of 19 to 20,000. I think we should be able to still close the year with 19 to 20,000, so which is within our guided range.
And what about FY25? How's it looking on volumes and EBITDA per ton?
FY25, we are again targeting another 20% volume growth over FY24. So we will continue to keep this volume growth momentum because our new capacities have also come in place, so it's ramping up. On a EBITDA per ton, right now we are keeping the guidance of 19 to 20 again for FY25 also. We are neither increasing nor decreasing because we need to see a lot of geopolitical situation because our EBITDA margins also largely depend on how the export market fare up because we actually do a premium market export, especially US and Europe. Those markets are very critical for us. And if the situation doesn't improve and all these West Asia situation continue to intensify, we will see some pressures on our EBITDA side. So therefore, we are keeping a balanced view of 19 to 20,000. Okay. At this point, I think we should be able to have those targets. And as we go ahead in that year, we'll see how we move ahead.
Let's talk about a couple of acquisitions then. The Rabi Run asset is what you'll have picked up, but I understand that it doesn't have cold rolling capacity as well. So maybe you'll have to invest into that. Give us some clarity on that asset. How much of more money do you have to put in that to get it up and running? And what's the plan out there?
Yeah, so Rabi Run is a good acquisition for us. We acquired it just 96 crore of investment. It has a cold roll capacity, but our focus initially will be to it has a pipe and tube, which actually provides a natural extension and going deeper into our stainless steel value chain. We eventually plan to have take it to 8 to 10,000 ton of PNT pipe and tube capacity, which should get a both decorative as well as industrial tube market. So right now it has a largely decorative tube facility of 3 to 4,000 ton, which will gradually start in next 6 months. Initial investment, what we are envisaging in next 12 months time is around 75 crore to start these facilities and that. And our focus initially will be mostly on the pipe and tube and both eventually take it to a more state-of-art pipe and tube facility, which actually gives the natural product extension and more deeper into our value chain.
Your debt has come down to 4,800 crores. You had a capex plan that's underway as well. So could you tell us where is this debt number headed? And also, has the cost of borrowing come down? If yes, by how much? I need to give it to you all because you said the promoter pledge will get released and that's happened. So kudos on that front. But give us an update on the debt.
So that side, you remember we said that FY24 debt, let me give you the linkage. We gave you the capex number of FY24 for almost 3,200 CR. And with that, the closing debt level, which was expected in FY24 was 4,700 CR. Now, anticipated capex of this year has increased because of two reasons. One is that Raviran, which we acquired, which has taken almost 96 crore. So that's one increase. And second, our Indonesia investment is going on a fast track. So our next tranche, which was expected in FY25, may get pulled into FY24 of around 225 crore additional capex. So overall, we may have an additional capex of 325 crore as against the 3,200. So expected capex could be now 3,600 crore. However, we are not revising because mostly we will still try to meet this increase also from internal accrual. However, so our closing debt number could increase slightly by 100 crore to 4,800 crore of that number, what you mentioned about it. So we are on track. We will prepone some of that capex also. On interest rate front, you asked me, I think the blended interest cost for our average tenure, we have increased our average tenure of the loan of close to 5 year plus. So that's one thing which we have done from refinancing on the back of rating and promoters pledge going on. And the current cost is close to 8%, which is very competitive cost. If you see last year, 1 year, the SOFR and has increased by more than 4%, and government securities rate have increased by 1.5%. Still, our rates have not increased to that extent. In fact, we have now converted our debt portfolio in a more robust manner to increase our average tenure. So there is no immediate repayment liabilities and reducing the current repayment liabilities. So balance sheet has been strengthened and the current debt rate is close to 8%.
Final question then, the imports continue to be a bit of an issue. What would be on your budget wish list?
See, our first wish list with the government is always that at least the domestic players should have a level playing field. I think we are seeing unabated imports from China. In some form, it should be contained. There are also already DGTR recommendations of the CVTs and anti-dumping. I don't know how this can be addressed in the budget. Second is that India is short of stainless steel scrap, which is our key raw material. So the duties should be a zero duty import, which should be allowed on these scrap because it anyway adds up to the circular economy from ESG front. So from that perspective, I think that those should be the critical thing which government should look at it.
Okay, well, let's head to the market pre-opening rates now. Looks like it's going to be a good pullback, actually. So the Nifty is up 150 points. You don't know what to believe because it's, really volatile market. But one thing you can say for sure is that IndiMart Bank's numbers might go down well with the street because of the stability in the margins. Abhishek is here to put the spotlight on that. Abhishek, over to you.
Well, as you mentioned, for 3 quarters in a row, IndiMart Bank net interest margin has been about 4.29%, and that steadiness is very good. So 12 quarters of operating profit growth, both YOY and quarter-on-quarter. This time it was at 8.5% YOY and about 3.13% sequentially. The ROA of 1.93% is the best in 17 quarters, and ROE of close to 15.5% is the best in last 16 quarters. RWA to advances ratio, that has also declined massively on a YOY basis. On the flip side, there were slippages. Slippages increased by 20.5% sequentially, owing to issues that you saw with respect to floods in Tamil Nadu. Annualized slippage ratio is at 3-quarter high, and cost to income ratio or the operating efficiency is perhaps one of the worst in last 7 years, with cost to income ratio close to 48%. However, PNL has beaten our poll both in terms of NI and PAT. Brokerages remain bullish on the stock. Some of them have increased the target price, like Nomura to 1880 from 1700, DAM Capital from 1720 to 1925. So largely the target price ranges from 1850 on the lower side to 2070 on the higher side. Back to you.
Thank you very much for that. IndiMart reported numbers yesterday. They are B2B sellers. Now, IndiMart was facing one key concern. The number of paid subscribers that they were adding every quarter was coming under pressure. Earlier, they would add about 6,000, 7,000, 8,000 quarterly subscribers every quarter, but this has been coming down, and in Q3, it stood at 1,826. The reason for the decline in the last 3 quarters, the company said, is that we effected a price hike and therefore we are seeing some churn, but that churn will settle, and once it settles, we will go back to seeing quarterly additions in their paid subscribers by 6,000 to 8,000, which used to be the quarterly run rate. In fact, in Q1, the company in the conference call, he said that we should get back to our guidance of 7,000 to 8,000 of net customer subscriber addition per quarter from Q3. That was the guidance given by the company. Now, that's not played out. In fact, in Q2, also the company said that, the churn has been much higher than what they were anticipating. We can't give you a guidance. This has been reiterated even in the Q3 conference call, which took place yesterday. We cannot give you a guidance on the quarterly paid subscriber additions till the churn settles down. But another concern is the company said that while they are seeing a slowdown in the paid subscriber addition, they were confident about the collections and revenue growth sustaining. Collections for the company used to be above 20%, but the slowdown in collections was also seen, and that's a bit concerning. That said, Nomura today has upgraded the stock, citing that subscriber addition is likely bottomed out, so they've upgraded it to a neutral with a target price of 2,530.
Okay, well, let's get to the market opening now. Here's the first tick on the index, looking pretty good actually for the market. 150 points higher on the Nifty, 21,600. The Bank Nifty as well is up almost about 400 points. So not a bad opening at all. A decent pullback is what we're seeing. Now the important part is whether we build on to the gains post this opening. The advance decline ratio also very healthy in favor of the advances at 1,500 stocks. LTI Mindtree is coming back up about 1.5%. HDFC Bank is up 1.5%. Tech Mahindra, Axis, Wipro. Interesting to see what IndiSInd Bank is doing because, this time the net interest margins are stable. You have ICICI Bank and Kotak Mahindra Bank coming out with numbers over the weekend. That's also going to be in focus. So all of these banks are up and about today with the Bank Nifty up 420 points. What's not looking good? Hardly any stocks in the red. Actually, Apollo Hospitals is the only one that's down about 0.5%. But apart from that, all banks are, and the Nifty components are in the green right now. So very good opening. The mid-cap index is also up almost about 1%. And then you have a lot of stocks in the mid-cap end of trade, names like IRDA, BEL, etc. that are up and about. So decent opening is what we're seeing. But important to see if yesterday's lows are held. And also, this 21,600, 21,500 mark is turning out to be a bit sticky. If that gets taken out today, maybe we can build on to our gain.
Oh, absolutely. 21,285 was the intraday low, but we put quite a distance from that level with the bounce today. In terms of the mid-cap movers, the mid-cap index is up 0.75 of a percentage point. On the way up, you've got Innova CapTab up 7%, pretty large volumes. EMS Limited has won an order. It's been declared the lowest bidder for a project valued at 480 crore rupees from the Uttarakhand government. So the stock is excited in trade. Easy Trip is moving up on pretty good volumes. In terms of some reactions, you had Poonawalla Fincorp. Strong numbers, AUM growth of 57%, and the stock has opened up in the green. Apart from that, you also have strength in Shalby, which is acquired a hospital in Gurugram. Persistent reports numbers tomorrow, and along with numbers, they will consider a stock split. And ahead of that, the stock is up 1.5%. On the way down, Metro Brands is down 5.5%. IndiSInd Bank is actually down 1.5%, despite the decent numbers, particularly on the net interest margins. Maybe it's the slippages, the higher slippages, which has concerned the street. Tata Communications gives up some of yesterday's gains, and Oracle Financial too is down 1.2% after the blockbuster rally yesterday. But I think, Prashant, IndiSInd Bank's stock reaction would have surprised a few.
It probably will, right? I mean, let's have the stock up on our screen. So not very much in terms of activity, buoyancy there. It's down right now about 1.5%. But I mean, it's just the start, right? On the Nifty, as you guys have been saying, it's a good bounce. Although I would like to see the market going up another 50-60 points. Stake out 21,700, which is the 50% retracement to the two-day fall, and then hold it. At that point, we'll know whether this is just a counter trend kind of a move after a sharp 600-point sell-off, or it's got more legs here to stretch on the upside. But we are 50 points away now from that. So 21,645. As we were saying, the bounce is coming into view. Now, let me just quickly highlight some of the other stuff as well. Market breadth is very positive. I mean, it's just the start, but 1,800 stocks are higher, and you only have about 150 stocks lower. IRFC is up 3.5%. Hoodco is up 3.6%. So it's a lot of PSU names again. Now, something like ITI is coming up with a 3% gain. Poonawalla Fincorp, you'll hear from the management a little later from now, 5% higher on that one. Solar Wilson, which is up 3%, so stocks at about 472. There is EMS Limited, which is, I think, limit up 5%, 481 on EMS Limited. You've got, what else? Both TV18 Broadcast and Network 18 are sharply higher, 5% and 4% respectively. Of course, these are, the channel you're watching is part of the same group. So just a disclosure there. Home First reported numbers, decent set. Home First is up 5% though. There's a sharp move, 1,033 on Home First. Jyoti CNC is up 2%. Ease My Trip is up about 3%. I mean, and I'm only sticking with the largest volumes that I can see on the screen right now. The top volume-led loser is IndiSyn with a 1.5% cut at this stage. Tata Communications is the other one. There's an upgrade from IIFL, but nothing on the stock. 2% lower on Tata Communications. And the big mover, which is Oracle Finance, which moved sharply yesterday, is down about 1.5%. So it's a very small pullback there. Dixon is another one. Keep an eye. 2.5 lower on Dixon at this point in time. And of course, Z moved up, I think, sharply day before yesterday and yesterday as well. Z is starting very tentative. Nothing. I mean, it's absolutely flat, almost unchanged from yesterday's close right now. Now, before I get in our market master, HDFC Bank should come up. It's at exactly the 1,500 rupee mark. Our market master of the day is Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life Asset Management Companies here in our studios. Mahesh, great to have you with us here. Thank you for your time. I have to start with HDFC Bank. It's a fun favorite, institutional favorite name. I've seen a lot of price damage over the last 2 days. Is it a buy here?
Yeah, I mean, we can't talk stock specific, but really if you look at in the banking sector itself, I think what the numbers have come in suggests that there has been some pressure on the deposit side, right? Because of the tight liquidity conditions which have been there. So your credit growth, demand has been fairly strong, both on retail and also we're seeing some pickup on the corporate side. But deposit growth has been lagging behind. And obviously there is some pressure because, I mean, on the loan to LD ratios, where the banks, the ratio is, because in the last few quarters, banks have dipped into the liquidity reserves to really cater for that credit. And with RBI also now kind of not exactly cautioning, but trying to see that, okay, the LDR ratio is within a particular frame. We're seeing some pressure on the banks in terms of the margins. And that is what is reflected. I think clearly, I think the banks will have to really step up on their liability side. And you could see some increase in terms of deposit rates going up. But I think overall, the banking sector, I think the outlook is still fairly decent. I mean, in terms of the credit growth, if you're looking at, has been fairly good. In fact, it's a surprise for this fiscal year itself. And with the overall investment cycle picking up, we would expect the corporate credit growth also start to pick up, which has been kind of sluggish for the last 3 years or so. And overall,
without going into whether buyers buying or selling HDFC, and I understand your constraints. What's the house view though? It's not a recommendation, but just because I mean it's a 20% on a name like HDFC in 2 days. That's significant, right? Yeah. So just give us I'm sure you've had discussions internally. What was the problem, and what's the way forward in your opinion? Nothing to do with the stock. Yeah.
So I think I mean it's a question about the whole sector. I think one is the over ownership, right? Because see, I mean, one is if you look at the IT sector, right? Any slight change in terms of guidance, okay, you see a sharp reaction. And the similar thing is happening in some of these stocks, right? Where the FI ownership is fairly large, and we've seen that, and as a result of that, any slight disappointment, I think the market reaction is much more violent. I think that's probably one of the reasons why we've seen the sharp moves in wherever FI ownership has been significantly higher. And apart from that, I think overall the sector itself, because a large weightage in the benchmark is a large ownership. So that's a sector which normally comes under pressure if there is slight disappointment. Otherwise, I think purely from a valuation standpoint, if you look at it, the sector is one of the few sectors where there is some amount of comfort, okay, in terms of the long-term averages. So I don't think that is an issue over here. It's also in terms of how companies are able to guide, because quarterly results and what's the kind of a guidance they give and confidence to investors that the outlook is good. I think it's also about how we communicate and guide, I think, which kind of managing expectations, I think, which is key in terms of how the stock reacts.
Okay. By the way, I just want to mention that the markets are looking very good right now. So 180 points in the green on the Nifty and plenty of stocks hitting fresh highs. Infosys is once again at a fresh 52-week high, so don't lose sight of that. Actually, post the IT numbers, Infosys has been gaining quite a bit of ground. I mean, it's back above that 1600 level now. You have L&T, Lupin, Sun Pharma all sitting at fresh 52-week highs as well, and something like a Godrej Properties too. Mahesh, hi, good morning. I wanted your thoughts on IT. The sentiment is a bit mixed, right? I mean, numbers are not too bad for some of them, but commentary is not great either. As an investor, what do you do now?
So the IT sector, I mean, this quarter was supposed to be a quarter where you would probably have got a reset in terms of what kind of a growth you will see for the next fiscal year. And market was a bit worried that you will see downgrades to the growth expectations. But I think by and large, I think the commentary which has come in is that, while things are still kind of weak on the discretionary side, it looks to have kind of bottoming out over here, right? Even the BFI sector, which has been the most impacted, things are looking at a bottom. So I think this is a sector where going forward, we're not expecting any kind of a large growth next year. Expectation is around 8 to 9% kind of a growth compared to around 4-5% growth in this fiscal year. But at the margin, I think things would look to improve in the IT sector. And again, our view is that US economy is not going to go into a deep recession. It will be a kind of a soft landing. And I think slowly and steadily, I think in the second half of next fiscal year is where you will see discretionary spend starts to come back, right? And over a medium term, if I take a 3-year view, I think the overall spend on digital and the cloud migration and AI related spends, I think that would mean their growth could still be reasonably good. So while this sector is not really cheap compared to the long-term averages, but looks to have bottomed out and can be a good contra buy actually. We are getting more constructive on the sector. We have been slightly underweight, but if I take a 2 to 3 year view, the sector should probably again go back to around 10-11% double-digit kind of a growth. And more importantly, I think the companies have shown that there's a lot of resilience on the margin front. So the margins have actually surprised a bit, and that's how they can drive a better bottom line growth. Even the top line growth is slightly sluggish.
So then, how do you make sense of the miss that we've seen from the likes of LTI Mindtree? Is that a company-specific issue or a one-off? If we do get such accidents in individual IT names, how would you read them? And considering that you are now turning constructive on the sector per se, would you up your weightage on IT in your portfolio? Because stocks typically tend to perform ahead of the improvement in fundamentals.
So I think there are always going to be company-specific issues in terms of their clients. If a large client is kind of downsizing, you would see that impact on a company-specific. But again, if overall, I think the company has got the right kind of a mix and they're good on execution, then I think we will use that as an opportunity really to look at some of those names. And so, I think from here on, we would look to add these stocks in any kind of a decline and increase our weightage. Again, here again, I think it can still be kind of stock specific, right? Depending on how the companies are being able to show a growth and how the order book, how the order wins have been in the recent past, because that will give visibility of growth in the near to medium term.
Okay, by the way, a lot of stocks, IndiMart is now up almost 6%. You have Oracle after the 30% gain post numbers. Oracle is up another 5%, so putting on some weight there. And Hoodco is up almost about 8%. Big volume growth is what you're seeing. You know, there are many themes that are picking up now, Mahesh, whether it is, religious tourism, whether it is tourism in general. I mean, that entire travel space, aviation, etc., hotels. Is this a space that you like, or do you think that the juice is all out in this sector?
So again, this has seen it. Initially, it was more of an open-up trade, and people thought that it would probably peter out. But I think the hotel industry and travel, I think there is clearly again a demand side, but more even on the supply side, we are not seeing much supply coming in. So I think the supply-demand imbalance, would probably ensure that it continues for a longer period of time, because capacity coming, especially in the hotel space, it takes time, right? It takes at least 3 to 4 years where you can see new capacity coming up. So I think both in the hotels and the aviation side, we see a fairly reasonable kind of profitability. I think the profitability or the average ARRs in the hotel sector are at a higher level. But we expect this to sustain for a slightly longer period of time. So the valuations, I think, in some of these space are already pricing in. So whatever earnings growth or volume growth one can expect, I think that's the kind of a return we could expect in this sector.
Just a few names here. Look at Oracle Financial Services, right? I mean, sharp move yesterday. It's moved once again to being the top volume traded gainer now. It's up 5%. So stocks at 68.31. So that's a 35% move in today's the third day then for this one. You got Z, which started flat. I was making a mention, is down 2.5%. So it's come off sharply. There are some reports, etc., which indicate that that Sony is holding a board meeting today with regards to the merger, and maybe they'll take a call, etc. But that's moved down. It moved up over the last 2 days. And of course, I mean, Dixon is the other one which we mentioned. Metro Brands is down 5%. We'll just be speaking with the company as well in a bit. 1155 is where Metro Brands is at this point in time. Mahesh, right next to you is the budget ballot box. You want to give us any recommendations? You want to put in something? We'll take that box to Delhi to the finance minister before the budget. By the way, you got two budgets, right? So if something doesn't come in the first one, there's still a chance with the second one. Yeah. Any expectation? It's a vote on account.
Right. No, really, I think budget in that sense, okay, I mean, there are not much expectations which are there. If you look at the earlier budgets also, right, we have seen there's nothing home, right? I think market, I think broadly, I think, I think from a market perspective, I think we've seen that on the, at least for mutual fund industry on the fixed income side, we've seen the indexation benefit, okay, which was taken away. I think if you really want to propagate the bond market in India, then I think there should be some kind of benefit given for long-term investors who come to the bond market, okay, through the mutual fund route. I think that parity is somewhere I think one would like to, because we've seen since then the flows into the mutual fund industry, into the fixed income space has kind of dried out. And it's very important if you're trying to build the bond market and liquidity. And that's an area where I think we would like to some kind of relook into it.
Okay. You want to write it down on that paper? There's one in front of you there. Maybe you want to just write it down, a little bit of it down, and then just pop it into that box.
Sure. We can do that.
But I mean, it is a vote on account this time, but there's a full-blown budget in July, right? So whatever are your expectations, hopefully the finance minister will listen to them and read them as we provide this ballot box to her. So,
sure.
All right.
Okay.
Thank you so much, Mahesh, for joining in. Well, that is our expectations from the budget and the budget ballot box, which, by the way, will be provided to you all across the city as well. So if you have any expectations from the budget this time or in July, feel free to put your thoughts, your wish list into the budget ballot box as Mahesh is doing. And then perhaps, we can take that to the finance minister as well. But for now, the market is still holding up quite well. The Nifty is up about 200 odd points. And let's get to Metro Brands, because that was the company on our radar. It was a soft quarter for them. They barely saw 6% growth on the top line, and the profit has declined. The margins have contracted. Nissan Joseph, the Chief Executive Officer at Metro Brands, joins in now to discuss their Q3 performance. Nissan, thanks a lot for joining in. I wanted to first start by asking you about the sentiment, because clearly across the board, consumer sentiment has been slightly on the weaker side. But can you quantify that for us? And what is your expectation as we move into FY25?
Sure. Good morning, Sonia, and thank you for having me. When we look at last quarter, it's really about tough comparables as opposed to economic headwinds, right? So last year, we had the COVID bump that helped all our sales across retail. And then now this year, we're going against those numbers. Having said that, though, when you look at our profitability coming in at over 17%, Pat, and I'm talking standalone numbers, you look at our year-to-date growth of being 10% over a very strong base. I'm quite pleased with the results we've come out with. And speaking to your other question, we are not seeing any economic headwinds. We're seeing, of course, timing headwinds, demand offsets from COVID bumps, but we're not seeing any economic headwinds that indicate to us that there's a softening in the consumer.
Okay. Will you grow at that 20% kind of compounded level, Nissan? I mean, brokers like Motilal, etc., believe that you can. Can you give us that confidence?
So I think if you look at us historically, we've grown at about an 18% CAGR, and that's a number we stay consistent and confident with. some years you're going to blip up, some years you're going to blip down. Last year was a big blip up, as we all know. And this year, when we go against that, there's going to be a little bit of going back towards it, getting back towards the 18% number. But, overall, when I look at the long-term runway of growth for Metro Brands, I feel very confident that we'll be able to achieve that 18% CAGR over a long, extended period of time, despite a few blips here and there.
And will you be able to hold on to margins of 30% plus at the EBITDA level?
Now, we've always guided to that margin level. We've guided that our EBITDA would be north of 30%. And last quarter was no exception. We came in at an EBITDA of 33%, which is a very, very healthy EBITDA for a retailer. I think a lot of people take the eyes off of that for a second when there's a comparable number that goes against last year that was extraordinary. But, if you look at it as a standalone number for this quarter, it was outstanding. You're talking about 17% PAT, you're talking about a 33% EBITDA, you're talking about our gross margins maintaining at 60% for the product level, which shows there's not a demand weakening because that would erode your prices immediately.
On Cravatex particularly, which is Fila, you did mention last time around, Nissan, that it could be a drag on profitability for a while. How long before you see a turnaround there, and what is the expectation as we move along?
Yeah, it's not could be a drag, it is a drag on profitability, but it's really an investment that we're making into Fila, right? We anticipate that drag to continue through this existing quarter, at which time we'll start to level off and won't be a drag on us. It may not be accretive to us right away, but it won't be a drag on us. And next year is really a year of resetting the brand in India. We see a lot of positive things coming out of Fila Global that we'll be able to piggyback with and create a demand for the product as we start repositioning it in this coming fiscal year.
So when you say level off, Nissan, could you put some numbers to it? I mean, maybe not this year, but say FY25, what will it look like?
Yeah, I think towards the end of FY25, we would start to be non-dilutive to us. FY26, we can see it being accretive to our numbers.
The implementation of the BIS standards for footwear has been deferred to 1st of January. So in the coming quarter, will there be any impact on your financials?
Yeah, there's actually two dates that are critical with BIS. One is the Jan 1st that we just finished, where some of the implementation started to happen. And there's another date of July 31st, where other pieces of footwear start to kick in and need the BIS certification to be legally sold. We think this is a very exciting program for India. I think it needs to be phased in to a certain degree because Indian manufacturing has not scaled up yet. So there's significant investments in PLIs towards it. As that happens, I think it's a good thing for us. What we have done here at Metro Brands is we forward bought inventory last year to ensure that we have the inventory to take us through any blips that come as BIS is implemented. But it's really a phased implementation. And with those phasings also, because these things don't have a history of how it was done in the footwear business. It's the first time India is doing it. So we will have some blips and bumps along the way, but overall, we think it's fantastic for Indian manufacturing.
Okay, you started by saying you don't see any indications of consumer demand softening. Would that mean that you're not going to go easy on your store openings? Because you did mention that you're going to open 200 stores in the next 2 years. Are you on track to doing that? And how are you seeing the e-commerce, side of the business? Do you see that plateauing a bit?
Yeah, so there's a couple of questions there. Let me take the first one. We're guided that we would open over 100 stores a year for the next 2 years. This year, we've already opened 85 stores, which puts us well on pace to exceed 100 by the time we get to the end of this fiscal year. We don't see a softening there, Sonia. What we do see is that, the retail euphoria of last year caused a lot of demand on real estate, that people were crazy to open up stores and, the euphoric nature of retail back last year. That has somewhat subdued down. And despite that euphoria of people opening up a lot of stores, we were able to keep on track with our guidance. And we don't see that slowing down. And mind you, that store opening does not include any openings we would have for Fila and definitely not for Foot Locker, which, as you know, we just signed on recently.
What about just one number, the same store sales growth? What was it in Q3 for 9 months and even going ahead? Is there any guidance that any number we could work with?
Yeah, we don't provide guidance on same-store sales growth. We never have, and that's not somewhere we do right now. But overall, we think when the timing trend normalizes, we should be at inflation plus 200 to 300 bips to it.
Okay, that's been your stated guidance. I remember even from the last conversation. Thank you very much for joining in and wish you all the very best. That's Metro Brands for you, down close to about 4%. The company is confident that margins will sustain above 30%. The stock, though, is a bit subdued. We will slip into a break on that note. On the other side, Naresh Jalan of Ramkrishna Forgings will join in to talk about the Q3 earnings. We'll also connect with Puneet Chatwal of Indian Hotels as the company opens its 200th hotel in Jaisalmer.
Co-present.
Welcome back. This is Corporate Radar, and the stock that we're looking at right now is Ramkrishna Forgings. Q3 was actually a very strong quarter for them. So you had a revenue growth of 36% this time around. The EBITDA was up about 30%. That's on a consolidated basis. There was a strong pickup in the domestic market. The stock is absolutely flat right now. Naresh Jalan, the managing director at Ramkrishna Forgings, joins us now to talk about that. Mr. Jalan, thanks a lot for joining in. I want to first start by asking you about the volume growth, right? In this quarter, the volume growth was very strong, 25% growth, largely led by the domestic market. Want to understand, is this a sustainable performance in Q4 as well? What are the demand trends looking like now? And what's the outlook for FY25?
Good morning, Sonia. I think demand trend is absolutely intact and we are doing extremely well, both in the domestic market as well as in the export market. And that is what has driven the third quarter volume growth. And I think this is sustainable and we are going to build up from here also. With the kind of capacities we are building in, I think this is the start of the traction in the volumes.
Okay, so can you give us a number? What are you looking at? I mean, you've done 9 months at about 118,000 tons. That's a growth of 23%. By the end of the year, by the end of FY25, what are you looking at in terms of growth in volumes?
So by FY24 end, we should be doing close to around 145,000 tons around capacity utilization.
Okay. The overall installed capacity is how much, sir, now? Okay, I think we lost the line there. We'll try and have him back in just a bit from now. But I think, while we wait for Mr. Jalan, let's just take a quick look at the market as well. 176 points on the Nifty. So, yeah, I mean, there is that bounce, which is at this point in time still staying. We, just to take a look at the index, I think we are at opening levels. Or have we given up? Let me just quickly see. I think we've given up a little bit, but not by much. The open was 21,615, and we're actually above that. So 21,631 is where the index is at, about 15-20 points above where we opened. So essentially flat line from that point on. Do we have Mr. Jalan? Okay, Mr. Jalan is back with us. Mr. Jalan, good morning. We lost you. There's Prashant this side. No, I was just asking you, what is the total installed capacity as of now?
As of now, Prashant, installed capacity is 210,000 tons.
210,000, and you're saying that you hope to utilize 145,000.
160,000.
160,000 by when, sir?
By this year end.
Okay, by the end of this year. And that would translate into revenue. So what's the number that I have is that by FY25, revenues potentially, because of capacity expansion, etc., could go up to about 5,000 crores. Could you give us an update?
Again, we have lost Prashant.
I can hear you very clearly, sir. Can you hear me?
Hello.
Okay, I think Mr. Jalan, can you hear me?
Mr. Jalan, is our voice reaching you? Okay, I don't think you can hear us. So we'll get back to that conversation in a bit. But the stock is holding up almost about 0.3%. Let's take a quick check on what's happening in the market. Hudco, by the way, is one of the stocks of the moment. Look at that. It's a 14% rise that we're seeing in the Hudco stock as we speak. NBCC is up almost about 6%. Honasa has come back in a big way, up about 5%. Poonawalla Fincorp has been looking quite good. Oracle Finance as well. Easy Trip too has been gaining ground because of this whole, wave of domestic tourism that we're seeing, especially with the Ayodhya opening, etc. So Easy Trip is up about 3.5%. And then you have something like an IRCTC. I think this whole tourism, related stocks are all looking really good today.
Yeah, and you mentioned Hoodco, Sonia. I think it's the entire PSU pack once again. I mean, that's because there's IRFC, there's IREDA, NBCC, and many others which are participating on the upside. I think we've got Mr. Jalan on the phone line. Some issues there with the audio. Mr. Jalan, if you can hear me, sir?
Yes, I can hear you, Prashant.
Okay. No, I was just trying to understand. We got the capacity numbers from you. You told us that by FY25, revenues should go up to about 5,000 crores. Can you provide us with an update? Are we on track on that because of the capacity expansion, etc.?
We are on, Prashant, we are on track to achieve our numbers. I think if you see the 9 months results and the fourth quarter is yet to come, post this fourth quarter, I think the entire visibility for 5,000 crores FY25 will be visible.
Okay. You had guided for FY26 revenues at 6,000 crores earlier. Can you tell us how much of this is going to be through the organic route, how much through the inorganic route? What are the plans there?
I think we are done with our inorganic growth as of now, and I think we are consolidating all the inorganic growths which we have made. So I think with this, whatever we have made right now, we are on track to grow our balance sheet and we aspire to be at the 6,000 crores number. But still depends on how commodity moves on from here. But in terms of volumes, in terms of businesses, we are on track for 15 to 20% volume growth.
So this board note to raise 1,000 crore rupees via a QIP, what will the funds be used for? Because you're just saying you're largely done, on the inorganic front.
So I think if you see the overall debt of the company has considerably gone down. I think we are at 590 crores of net debt as on 9 months, and our target is to by next 2 years to be almost debt-free company. So I think that's the vision we are working with, and I think with the kind of growth we foresee, I think we believe that we will be able to achieve the vision which we are working with.
And when will you raise this QIP money of 1,000 crore rupees?
We have already raised. I think that's already over, I think.
Okay, got it. So you're saying your target is to be debt-free over the next 2 years. Got it. The last time you had said that you're hoping to surpass double-digit growth in the railways business. Can you tell us this JV, right, with Titagarh, it will start accruing in FY27. But before that, you don't expect any incremental orders to come through in the railway business? Just trying to understand in the non-auto side, what are the opportunities that you have?
In non-auto segment, railways and off-highway business is both doing extremely well for us. And we are on track for FY25 double-digit growth in railways as well as off-highway. So both these segments taken together, I think our overall exposure to the automotive segment is going to considerably come down. And we aspire to be almost 30% non-automotive business, and we are on track to achieve that.
Railway as a proportion of the overall business, that is under 5%, right now?
Yes, around 4% right now. And we are looking at almost 10% by this FY25 end.
Oh, wow. I mean, basically, the share to double from more than double from where you are in a year.
Yes.
So is there a big difference in the margins of the railway business and your core margins?
I think railway business, being a very specialized operations, has a better business, better margins actually.
Okay. Do you want to put some number to it? Better margins is?
No, I think it should be 100 to 150 basis points more than what we do for automotive segment.
Got it. So just one final question. The 6,000 crore target by FY26, you're saying that all of it will be organic, right? There won't be any inorganic, because last time you had told us that you are looking at some acquisitions as well in some of the complementary spaces. So just wanted to get an understanding on that.
So I think we had just closed on the ACIL MTech through NCLT. So I think we have 3 acquisitions within last 3 months' time, and I think we for next 1 year or 2 years, we believe that we should be consolidating all these acquisitions in RKFL. And that is the way forward. And I think with all these acquisitions, we are on track to achieve the volumes which we predict we will be able to. And with all these new customers which have come on board with these acquisitions, I think to cater to and cross-sellings which are going to happen through RKFL also, I think we have a huge opportunity and huge task in our hand to consolidate everything.
So ACIL, last time you said that 500 crores is a revenue that you're looking at in 2 years post the acquisition. Are you on track to do that, or is there any updated figure that you want to share with us?
No, we are on track to achieve within next 2 years by FY26 end. We are looking at almost 500 crores revenue from ACIL.
Okay, all right. Mr. Jalan, we'll leave it there. Thank you very much for your time. Good speaking with you here on CNBC-TV18. Good luck, sir. Well, Indian Hotels recently touched a historic milestone. It opened its 200th hotel in Jaisalmer. My colleague Mangala Malu caught up with the managing director and CEO of the company, Puneet Chhatwal. He began by asking Mr. Chhatwal on the milestone itself and, of course, growth and expansion plans going forward. Listen in.
Well, it's a double century, so it's always good. Hopefully, very soon we'll be having a triple century because we have 80 plus hotels in pipeline, and the guidance that we have given under our strategy is to have a portfolio in operation or under development of 300 plus hotels by the end of next financial year.
So let's talk about, the recent events that happened. There was this shift towards Indian destinations, Indian coastlines, and then we were reading reports of you already having a property in Havelock. You already have a property in a lot of the Indian beach areas, and you are probably planning 2 hotels in Lakshadweep as well?
That's correct, in the islands of Soheli and Kadmat. And we signed those almost like 10 months ago, so the design is getting very close to the completion phase. And we hope to get under construction in the next 3 to 6 months, subject to all the planning and all the approvals that are needed.
So how many keys would both these properties be?
Because we are still in the final stages of design, and the endeavor or the aspiration is to get at least 200 in both of them together. And that comes with the number of villas we'll do, the number of suites we'll do, the number of 3-bedroom properties as standalone that we'll do. So we are aiming to no less than 200 for both the islands together.
How do you see the positioning of Lakshadweep versus Maldives right now in terms of pricing, in terms of the kind of people that are likely to go there? Do you think your Maldives property saw some cancellations, etc.?
Maldives is a well-established destination for so many decades, and destinations are not built in a day. If you look at Goa, it took us almost 30 years for Goa to get where it is today, but we built the Fort Aguada 50 years ago when that was the need of the hour. So this year, Fort Aguada celebrates 50 years. So it takes time for destinations to get built, because it's not just the hotel. It's the entire infrastructure that a destination needs. And no matter how much you fast track, it is not we open a hotel and then there'll be a queue of people. Yes, there will be a queue of people wanting to go to the Taj, but they need to get there too. So I think destinations need to evolve, but from its beauty, it is maybe even higher rated by most people who have visited these islands than the Maldives.
I wanted your thoughts on, since you spoke about the infrastructure and the ecosystem that happens when something of repute comes to a destination. We're all talking about the Ayodhya Ram temple, right? There are a lot of hotels looking to open their doors. You have a property out there as well, which will open in the next couple of years, etc. What do you think of this spiritual tourism as a sect right now in terms of a business opportunity? You have, if I remember correctly, a couple of hotels in Tirupati, a few in all the other places as well.
Actually, you'll be surprised. I think nobody covers the spiritual destinations in India as we do. We can boast of almost 50 hotels, a total of 50 hotels in operation and a few under development in different spiritual destinations. and a lot of expansion that is going on there. So as an example, we are adding 100 new rooms which are under construction in Taj Ganges. So that'll be more than doubling the size of Taj Ganges. We have added a few rooms in the Nadesa Palace, the traditional palace. You know, it's not possible to just expand it in the way we want, but we'll be adding luxurious tents out there. So we are in Banaras. We are in Tirupati with a Taj, but in the next 6 to 8 weeks, we are opening another property out there. So there will be a second property. We are at the Golden Temple with the Taj in Amritsar. So the list can go on. And we are very pleased because spiritual tourism is something that has gained a lot more recognition. It has gained a lot more in importance. And honestly speaking, it is crisis resistant. Unless a COVID-19 lockdown hits you, I think one place where people will always go, whether it's a wedding or it's sad news or it's praying for more success or praying for whatever else you want, that is a spiritual destination. And we are very strategically focused on increasing our presence. And many of these destinations will not have just one brand, they will have most of our brands. Now, Ayodhya over time will see a Vivanta, a Ginger, a Selections, a Taj. All four, and any new brands we might do in the future.
You said that the demand is likely to outpace supply in the near future at least. Do you think the costs are likely to outpace the rate at which demand will grow as well, or do you think you've managed?
Question. So inflation is there. It's not that the costs have not increased, but our ability to charge is far higher because of the quality of demand and the quality of supply. So as long as demand outpaces supply, your ability to charge is higher. If your ability to charge is higher, it's easier for you to absorb the increase in cost. At what point does it hit
that growth ceiling in terms of your ability to charge?
When it reverses, the supply is higher than the demand, and we have been through that post 26/11, post global financial crisis. And the entire sector witnesses that when something happens, like the global financial crisis following Lehman, the entire Western world was very badly impacted in the hospitality sector. Demand really crashed. So COVID-19 was another such situation that came.
What about the property backdoors? We have the Taj Sea Rock. You said that you were awaiting some clearances.
Yes,
some of them you got.
Happy to share. I think I did that already. But we have got the fire NOC, and that's a very big step. The next step is getting the permissions from BMC. Then it will go to MOEF, and the process is on the way.
I'm basically asking, what's the kind of investment outlay that you've envisaged for something like this?
An investment like Sea Rock is, it's as a listed company, we always have given those figures is in our books at a very high level in terms of the pricing of the land. So all in all, after building, it's 2,000 crore plus investment in a single asset. The good thing is more than half of it we already have, and we don't expect or envisage to spend the rest of the money on our own. We'll get somebody to partner with us, and us keeping the majority, and the rest of the capital, I'm sure, on an iconic asset like that, which would not just be iconic for Taj, but iconic for India, just like the founder Jamshedji Tata built the asset in Kolaba. This would be the asset for the next 100 years for this part of town. I'm sure we have many aspirants as partners, both within the group and outside.
That's Indian hotels for you, but one of the stocks of the morning is IndiMart, and this is despite reporting subdued numbers. The stock is up 7%. So here's telling you why. One, Nomura has upgraded the stock to a neutral because they believe the subscriber addition, the paid subscriber addition, has bottomed out. If you remember, over the last few quarters, the company's quarterly addition in their paid subscribers is coming down. Till last year, it used to be between 6,000 and 8,000, 7,000, 8,000. But in the last 3 quarters, it's steadily come down. And in Q3, it was a figure of about 1,800 paid subscribers on a quarter-on-quarter basis. Nomura believes that's bottomed out, which means in Q4, they're anticipating that paid subscriber number to go up from 2,000 to 5,000 and then above 4,000 in Q1, which is why they've upgraded it. Their target stands at 2,530. Anand Rathi too has upgraded it. They're saying the valuations are attractive. Their target price now stands at 3,100. It's lower compared to their previous target, but IndiMart has been an underperformer. Its 52-week high is a level well above 3,000. So the stock has been an underperformer, but Anand Rathi upgrades it to a buy, keeps a target price of 3,100. 6%, 7% up on that stock now.
Okay, well, a couple of numbers. Reliance ahead of its numbers actually is under a bit of pressure. So while the market is doing well, Reliance is not. Poonawalla Fincorp also reported a good set of Q3 numbers, and the stock currently reacting positively to that. Their assets under management grew 56%. To discuss more on this, we have Abhay Bhutada, the Managing Director of Poonawalla Fincorp. Abhay, thanks for joining in. Can you start by telling us what was your incremental cost of funds this quarter compared to the average cost of funds?
See, our incremental cost of fund is 8%, and our average cost of borrowing for the quarter was 7.99%. So almost flat on a quarter-on-quarter basis, despite of RBI tightening the policy, despite of 225 bips increase in the interest rates and market condition, there is no impact on the overall cost of fund because of a proper mix of CP, NCD and the bank borrowing. We are a CRISIL AAA rated NBFC, so that's why we are able to maintain the cost of fund at sub-8 levels.
So do you see the cost of funds going down from these levels?
So for 1 or 2 quarters, maybe liquidity will be tight in the market. So we don't see a major impact. But we have a lot of short-term lending, almost 20-25%. So we are focusing more on the CP, which we get at a lesser level, though right now that is also again getting at a higher rate. But yes, 1 or 2 quarters down the line, subject to RBI policy, you may expect reduction in the overall cost of funds.
Right. Your net interest margins this quarter was up year on year, but it was down on a quarter-on-quarter basis. What would you attribute that to? And what's the outlook on this margin going forward?
See, if you see, we have always guided about 10% over a last period of 2 years because of lot of short-term product in nature. We get good amount of profitability over there. And considering the current cost of fund RBI rate increase, I think we have clearly guided that we will be able to maintain and confident to achieve about 10 level on a long-term and steady-state basis. And lot of legacy rundown, legacy our old Magma loan book, legacy rundown and legacy write-off, it gets adjusted as per the accounting standard into the ECL. It is not getting added into the revenue. So as such, on a sequential basis also, there is no, in actual sense, there is no reduction in the NIM. However, still on a long-term steady on basis, we will be able to maintain about 10%.
Your disbursals are up 11% on a sequential basis. Do you expect this kind of loan growth to continue? And also, just one more word, the RBI has raised the caution on unsecured lending. What's your view on the same?
See, basically, if you see my current leverage is 1.5 and capital adequacy is 38%. So we don't see any major impact in terms of growth, but at the same time, we want to stick to our guidance of 35 to 40%. We are able to maintain secured unsecured ratio of 50%. This quarter secured is 52, unsecured is 48%. We don't lend to new to credit customer. We lend to where there is a cash flow, bureau tested customer, there is a business vintage and credit tested customer. So practically, if you see the segment which we are operating, you cannot give same treatment or anyone cannot give same treatment to all. We have a learning from our past in terms of all the unsecured product. There was a NBFC Poonawalla Finance of the same group, wherein we used to do personal loan, professional loan, business loan. So we have learned 2 to 3 years over there, all the unsecured products. And with this, our learning, strong risk culture, what we build in the organization, strong risk management, strong analytics team, I think we don't see any challenge. If you see our new book is performing well, better than our expectation. So if you see the GNP also out of 1.33%, our GNP is only 0.42% in the new book. And NP, net NP is only 0.23 on the new book out of 0.70. So we don't expect there also, whatever guidance we have given, net NPA will be below 1 as per stated management vision 2025. So coming back to your question, we don't see any impact of this RBI circular. In fact, we are getting advantage because of this. Lot of players, they are not able to raise the funds. The cost of fund is high. So on the fintech side, on the NBFC side, those who are leverage of above 4 and 5, they are struggling. Our leverage is 1.5. So I think we are getting advantage. In fact, there is an opportunity, and we lend only above 50,000 ticket size. The major impact is for a smaller ticket size, those who are lending below 50,000. So if you see overall, there is no impact on the Poonawalla Fincorp.
All right, you mentioned that liquidity will remain tight over the next 1 to 2 quarters. How do you see that changing your liability profile, if there's going to be any change at all?
See, right now there is no impact, because if you see last quarter versus this quarter, hardly there is impact on the cost of fund. So because of our less leverage, we sold our housing to TPG. Last quarter, we got post-tax 3,000 crore rupees. So now we are sitting with the excess capital. Capital adequacy is also 38%. Even if we grow at 35 to 40%, we will not require any additional capital over a period of next 3 to 4 years. So we don't see any major impact. And we have a diversified term loan, WCDL. We have a commercial paper, NCD. So we have well diversified NBFC in terms of liability profile as well.
What is the outlook on credit costs for the remainder of this year, and more importantly for FY25?
So credit cost, we have given guidance of in the range of 0.8 to 1.2% on a long-term basis. On the GNPA side, we will be able to maintain below 1.5. Net NPA will be able to maintain below 1%. And if you see the current GNPA and NPA number include the legacy book, if you exclude that, the numbers are on a much lower side. But yes, whatever stated vision management 2025 we have given, will be always able to maintain net NPA below 1.
Thank you very much for joining in. That's Poonawalla Fincorp for you. Slip into a very short break. The market continues to remain steady, 180 points higher on the Nifty, 21,650. Sensex cruising at a 650-point gain. Get into a break. Mitesh Thakkar will join in on the other side.
Welcome back. Mitesh Thakkar is joining in now to tell us how to approach the markets. Mitesh, how are you feeling about the situation? I mean, it's looking very good on the charts, but we all know how volatile things have been, right? What do you do for the rest of the day?
So, good morning again. One, I think it looks like that the bounce back from yesterday's lows continuing. And as I said, the best case scenario is 21,758. If we don't start getting past that, then I think in the next couple of days we could see one more down leg to this market, and we could possibly be in for a retest of 21,300 again. But overall, till this is there, I think just try to trail your stop losses to 21,535 on the Nifty spot for protecting your long side, and around 21,750 plus levels. Around those levels, try to take profits. On the stock side, Coal India has come on the radar today. I think that's a stock which is trying to reverse after a few days of consolidation. So buy here with a stop at 375 for targets of 395. And Aarti Industries is the other one. That's a buy as well. It's moved up a slight bit in the last 30 minutes, but try to buy it closer to 640 with a stop at 625 for a target of 675.
All right. Stock did well yesterday as well. Thanks very much, Mitesh. Good speaking with you. We'll come back for more later. But the index is doing well, right? The Nifty is at about 21,640, 170 points strong. Well, it's time for a quick commercial break here. But on the other side, it's our special segments, the economy. My colleague Lata will be chatting with Srinivasan Varadarajan of Union Bank of India to talk about the sort of earnings of HDFC Bank, with the stock performance, and of course what this means for the banking sector as a whole. We're back with that in just a bit.
Co-powered by